Good morning, everyone. My name is Jessica Blumenthal, and I'm a director in the Banking and Finance Department at ENS Africa. Welcome to today's masterclass. It's the 10th in our series. If you're joining us for the first time, this series, like those before it, is presented by the Banking and Finance Department to assist the financial services sector, or at least those in the sector, to obtain the CPD hours that they need to meet before the end of the CPD cycle at the end of May. This year, we are presenting 16 hours of continuous professional development accredited masterclasses. And we've been using this opportunity to canvass topics that we believe are of importance to the industry. We've brought together panels of experts to unpack some of the emerging risks and trends. And we've drawn those experts from the various departments and jurisdictions that make up our firm. What all of these experts have in common is a commitment to their own continuous learning and to considering how their practice areas are impacted by the rapid and numerous developments in what we call or can call for shorthand purposes, the ESG space. So just some housekeeping points before we kick off today's exciting panel. If you are joining us for continuous professional development reasons, then remember that you need to remain online for the duration of this masterclass for the full hour in order to be eligible for your CPD certificate. Our team will, if you have remained online and they've been able to verify that, then our team will send you your certificate within 3 days of this masterclass. Then, as I mentioned, we are presenting 16 hours this year. This will be our 10th. There are 6 masterclasses still to come. And if you're interested in any of those topics or engaging with those panels or presenters, then please do register and join us for those. You can either use the link on the original invite that you would have received from our events team, or you can email our events team and they'll assist you with that. We do invite you to ask questions, although we have quite a lot to get through in this panel, and so we may not be able to address your questions live online. But if you have questions while we're speaking, please do put them in the Q&A block at the bottom of the screen. We'll address any questions that we can, and if we run out of time or we don't get to your question, we'll be able to interact with you directly. And of course, you can always reach out at any time to any of the panelists, particularly if you have a question on their specific area of expertise. And finally, if you would like to ask a question in person, we are hosting a cocktail event in both our Cape Town and Johannesburg offices. And that's really an opportunity for us to meet you. Some of you have been with us through this whole series, and we're very grateful for that and for your attention. And some of you we haven't met before, some of you are clients who we know very well. But please do join us at either of the cocktail functions, Cape Town or Joburg, or both if you are a person who commutes between the two cities, and you'll have an opportunity then to engage with the panelists in those 2 locations. So today I'm very happy to be welcoming Professor Angela Itzikowicz, who is one of ENS Africa's preeminent fintech regulatory specialists, also from the Banking and Finance Department, Ridvan Boda and Priyanka Naidu of our TMT team, and Bernard Dippenaar of our intellectual property team. So those are my esteemed panelists for today, who will be sharing their insights from their own perspectives and their own practice areas as to how fintech can enable sustainability. So thank you to all of you for joining us today for this discussion. So we know that in order to overcome the myriad challenges that we face in this volatile, uncertain, complex, and ambiguous world, we need real-world outcomes that drive the achievement of the SDGs, deliver on the commitments that have been made by countries under the Paris Agreement, and achieve the targets of the Kunming-Montreal Global Biodiversity Framework. To do this, we need scale, we need rapid change to business as usual, we need innovation, inclusivity, and disruption. All of the things that fintech can deliver, making it the ideal medium to enable new ventures, new ideas and solutions that are able to meet these challenges and ensure that we attain a shared future prosperity for both people, economies, and the planet. And that's the theme of our discussion today. We're going to be looking at fintech through, as I said, a couple different lenses from the different practice areas represented on this panel, and unpacking that a little bit for you. And Angela, I'm going to turn to you first, please. to kick us off, and I'm going to ask you to please give us a brief outline of what Fintech is and to describe for us the regulatory environment in South Africa in which it operates, perhaps touching for us on how important an enabling regulatory environment is to actually enable Fintech and to allow innovation to thrive. So if I can ask you to address that, please.
Sure. Thank you very much, Jess, for the introduction, and thank you very much to all attendees, both those who have attended previously and those who are here for the first time. So let me begin, as you've suggested I do, Jess, with a brief discussion of Fintech and what Fintech means. And for those who are well-versed in Fintech, forgive me for carrying coals to Newcastle. But let me start off with the terminology Fintech. Fintech is really a contraction of the terms finance and technology. Brought together, Fintech means the delivery of financial services using technology. Now, very often, I have found that people conflate the term Fintech with Bitcoin, Fintech with crypto, Fintech with distributed ledger technology. And that conflation, while understandable, is quite wrong. First of all, the distributed ledger technology is really the rails along which a number of Fintech products run. It's not a product per se, and indeed, distributed ledger technology can be used for a myriad of purposes. It's becoming quite popular in trade finance. It's becoming popular in the medical world. So that's simply the mechanism, the road along which Fintech and other areas can run. So what is Fintech then, besides being a contraction of the terms? I think the easiest is to see Fintech as a big umbrella term. Going back to the maths or the arithmetic that we did at school, maybe seeing it as a set. Using parlance, which is maybe closer to us, see it as a big file headed Fintech. The file, the subset, the umbrella has a number of subsets or folders below it. And those include payments, crowdfunding, peer-to-peer lending, robo-advice, crypto assets. So crypto assets is a subset of Fintech. Insurtech, regtech. So just to drive home the point that it is a very, very broad term with a number of subsets. Mobile money, mobile banking is a subset or a folder in the Fintech file. As is a rewards program, let's take one of the chains. Let's take Starbucks, for example, where you can make payment using your phone and also acquire for yourself through the issue of rewards some proprietary interest, at least in the coffee. So just making the point that it's a very broad term. Turning now to financial inclusion. Well, I know financial inclusion too is a very broad topic. And that really means, for my purposes, a means that individuals and companies which grant them access to financial services that are important to them. Again, banking, saving, insurance, loans, credit. So the services must meet their needs. And of course, they must be delivered in a responsible and in a sustainable manner. Quite interesting when I was reading around this. Financial inclusion is not something which is peculiar or relevant only to underdeveloped countries or third world countries. It's quite interesting to read yesterday, even in a sophisticated country such as the UK, there are a significant number of people who don't have proper access to financial services. So it's not something which has a context only in poor countries, in poor countries. So why this problem with financial inclusion? Very briefly, what are the barriers to financial inclusion? Well, poverty in itself is a huge barrier to financial inclusion, because if you don't have any money, then of course the access to financial services means nothing to you. Another very important barrier is the physical distances that some people have to travel to access an ATM or a post office or a bank, particularly in the rural areas. The third, again, now this is peculiar, I think, to developing economies, and it's very difficult to define a developing economy or developing country. People like the comfort of cash. It gives them the security, some kind of security and comfort, knowing that they have money in their pocket or money kept in the mattress or in their beds under the mattress. Further barriers to entry would be minimum account balances and very, very rigorous account opening processes, such as what you would need to provide in opening a bank account, such as your customer due diligence documents, your ID document, your proof of residential address. Now, many people have neither an ID document nor a proof of address. So those are just some of the barriers to entry. Now, everybody is looking at financial inclusion. I think in years to come, it might well become the zeitgeist of its time. So much so that the World Bank has a paper or elaborate policies on financial inclusion, as does the United Nations. The United Nations has a very interesting United Nations Financial Inclusion Development Program, which has a very strong focus or bias towards underbanked or unbanked women. Sorry, let me just get rid of this. Apologies. The private sector also has and strives for greater financial inclusion, because private sector inclusion provides a very strong boost to the economy. And then, of course, financial inclusion drives profit for banks and other financial institutions. So the rise of fintech has undoubtedly been something which has dismantled financial exclusion to a certain extent, which is certainly conduced to financial inclusion. I mean, one only has to have regard to the number of digital banks that have sprung up in this country alone. Now, of course, if you don't have, physical offices, or you can open a bank account through a participating retailer, the time to open that account and the expense in opening that account reduces significantly. And it may be interesting to note in passing that South Africa had the fifth, I think it was the fifth, I forget when the census was, but let's say 2 years ago, it had the highest bank charges or the fifth highest bank charges, in the world. Quite significant, given that even though we have a sophisticated financial services sector, we still are a third world economy or developing country. Of course, disintermediation in the form of cryptocurrencies can reduce the cost significantly, because there is no centralized party. There's complete disintermediation. Robo-advice, if you don't have to incur the costs and go through the hurdles of financial brokers, of course, it's going to drive inclusion, and of course, it's going to bring down the costs significantly. So what I've done really, just to give those of you some steer, because I don't think this is a topic which warrants slides. I think it's one of interest rather than anything else. So I've looked at the term fintech, what it means, what financial inclusion means, of course, very, very briefly. And I've tried to bring the two together to speak to the theme, which is how fintech has enabled or conduced to the breaking down of financial exclusion. So make one point. Everybody thinks fintech is novel. Now, fintech has been around forever. Financial institutions and banks have been looking to provide greater, quicker access to financial services since the advent of the ATMs. Now, this happened in the 1960s, and credit cards predated or antedated the ATMs. So fintech as a concept is not new. Of course, the technologies underpinning the fintech, such as artificial intelligence, such as big data in its various iterations, the technology has moved incredibly quickly. And that brings me to the real focus of my discussion today, or my thesis, as it were. Yes, I can give you many examples how it's enabled financial inclusion, but has the regulation, and more importantly, the implementation of that regulation, what has that done for financial inclusion? Has it enabled it, or has it been less than empowering? Now, fintech as a topic, financial inclusion as a topic, and certainly the regulation of fintech, those are topics which one could spend days and days and days on end having very interesting debates around. So my view is this. Regulation, or the drafters of regulation, fintech regulation, have adopted what we call a functional approach to regulation. They've said, what we must look at is the function that we are trying to regulate. If it's lending, be mindful of that function. If it's banking, be mindful of banking. If it's insurance, be mindful of the function. We must, as far as possible, be technologically neutral. And this is the stance of most countries in the world. I think, and I speak subject to correction, leaving Venezuela, which has its own cryptocurrency as a medium of exchange, most countries adopt this approach, a functional rather than a technological approach to regulation. And that's fine. I think that is the correct interpretation. And I have sympathy for the drafters or amending regulation to cater for fintech, because it's very difficult to keep up with innovation. And it's often been said that fintech regulation is really just a case of putting old wine into new bottles. Now, in thinking about this yesterday, that's fine, but I was thinking to myself, would this analogy perhaps not be more apposite? Aren't we in some cases trying to squeeze a 14-year-old boy into a 4-year-old's clothes? Now, I think it would be a hugely interesting study to take each of the statutes that seek to regulate fintech, not directly, but through including fintech and technology into the existing regulation. But obviously time doesn't permit. So I thought I would take lending as an example. You know, everybody needs to borrow money at some stage in their lives. Very difficult for someone who has never had access to financial services to approach a bank and ask a bank for a loan. And I reiterate some of the hurdles that he would encounter. He has no financial history. He can't open a bank account. He doesn't have the correct customer information to enabling the opening of the account so as to enable him to be provided with a loan. So what happens in our country, in particular, in most African countries, they go to machiniches, loan sharks. They are driven underground or to the underground or parallel economy in their quest to borrow. Now, a wonderful solution which arose in this country and elsewhere is the concept of peer-to-peer lending. Now, very briefly, this would work as follows. Angela needs to borrow money. She doesn't have access to financial services. Jess and Priyanka and Ridwan and Bernard, they'd like to make money more than the interest which they would earn in leaving it in a savings account. So let's assume I want to borrow 150 Rand. The likes of Jessica, Bernard, and Ridwan and Priyanka. Let me leave you off for a minute, Bernard, just because it makes the sums easier. So the three of you would like to lend 50 Rand each to me. That's wonderful. It's meeting all of our objectives. You could get stipulated interest according to the MCA, which might be higher than that you would get in your savings accounts. Similarly, I now have access to a loan, which I otherwise wouldn't have. No, so adopting the functional approach to regulation and legislation as we must, the first point of call would be the National Credit Act. And the question there would be, does the National Credit Act, looking at its function, govern peer-to-peer loans? And the answer is, it does. But now, is it right that it should be? Given that the National Credit Act now regulates all loans, there's no threshold. The 500,000 threshold, the 100 loans on your credit book has been done away with. There's a threshold of 0, if indeed you can have a threshold of 0. What that means is that each of Ridwan, Priyanka, you, Jess, would now have to register as a credit provider. There's no regular feature requirement in that act either. And that is quite honestly ridiculous. If one has regard to the purpose of the MCA, which one must, it is to make finance, to make loans more accessible. But no one is going to register and go through all the hurdles of registering as a credit provider if to make a loan of 50 Rand. Equally, I may not meet the strictures of the National Credit Act. I may not be able to provide proof of income to the extent required by the MCA. Why can't we use alternative data like cell phone data to meet the requirements of affordability? So that really, the MCA, rather than enabling financial inclusion, rather than making access to credit more accessible, has in fact had the very opposite effect and has killed the peer-to-peer platform economy in this country. Now, I'm conscious of time, and there's nothing worse than one of the panelists who erodes everyone else's time. But the same is true of buy now, pay later products. And I know Ridwan has an interest in this, particularly as regards payments and the platform economy. Now, if you are going to have every person who offers buy now, pay later products, if you're going to make them register as credit providers, and worse, make me, who wants to split my payments over a period of 4 weeks to buy a pair of running shoes, provide proof as required by the National Credit Act, that too, in a matter of time, is going to be destructive of the peer-to-peer lending or the buy now, pay later product. And as I say, there are those obstacles in almost each of the fintech sectors. But I think that's enough from me, and hopefully I've made the point cogently that while it's laudable to adopt a functional approach, one must be careful not to squeeze the 14-year-old boy into the 4-year-old's clothes. They just won't fit. Thank you very much, Jess. Thank you, everybody.
I think you've made that point very well. I was thinking of your bottle analogy and how if we are going to get the rapid change we need and we're going to be able to use innovations like peer-to-peer lending that you've been describing to ensure something like financial inclusion, which we know we need to meet SDGs, we're almost going to need to smash that bottle that you were talking about in the beginning in order to enable that. And Ridwan, let's maybe move to you. And Angela mentioned briefly the platform economy, and it's something that I know that you're very passionate about and have advised on extensively. And I think if you could, obviously platforms are, as a form of fintech, or to use Angela's example, one of the sub-files underneath the large file, they don't always produce the outcomes that we need in terms of implementing the SDGs, but they do present an opportunity for scaling, innovative business, or new ideas that can disrupt something that is considered business as usual and can help to take us that extra step further that we need to go. Can you share some of your thoughts on that with us, please?
Absolutely. Thank you, Jessica. And thanks all for having us today. So I think I agree with the notion that platform economies, whilst they're not always directly aligned with implementing the SDGs, they do offer very significant opportunities for scaling innovation, scaling disruptive businesses, driving developments towards more sustainable practices, and also fostering inclusion. Before I expand on this, I think let me take a step back and just touch on what do we mean by the platform economy. If you think of a very early example, when banks started digitizing their operations, there were multiple channels. And through those channels, eventually you were not only doing banking services, but you also were now buying airtime. You were able to buy electricity. So that's a very early example of a platform where an existing established player is utilizing their technology, utilizing their customer base to be able to offer products and services which are not their own products or services or within their traditional businesses. Like this, a number of companies have all embarked on a platform strategy. If you look at all of the major banks, even a lot of the digital banks in South Africa, if you look at the telcos and even the retailers, all of them, there's a significant migration shift from being a very traditional player in a very traditional business to becoming more of a platform player. And what a platform entails is ultimately an existing company. It doesn't need to be an existing company, but usually it's an existing company with an established brand building a technological platform. And through this, enabled by cloud computing inter alia, but through this platform, they're able to not only offer their own products or services, but also offer a number of products or services from a number of parties. If you think of examples, Nedbank, for example, have the Evo platform. Standard Bank have something called the One Hub platform. Likewise, MTN, Vodacom have moved from being traditional telco players to now being very big in financial services. So all of these are examples of existing companies utilizing or leveraging their brands, utilizing their technology to be able to onboard or bring new solutions to market, encouraging mass market adoption. When we look at the role players in the platform economy, there's essentially 5 role players. And I think 2 of these are critical for financial inclusion. The first role player is actually the platform provider themselves. So it could be a company who sets up and establishes a platform. It's not the easiest or cheapest thing in the world to develop a platform. It does take a considerable amount of investment. But for companies who have gone down that route, it offers significant returns and opportunities. So that's the first role player. The next role player is the technology companies who enable platforms. So these are people who actually build platforms. And this could be anybody from the Amazons to the Microsofts to Salesforce. And there's literally hundreds or if not thousands of companies which assist in enabling platforms. The third role player is regulators, often overlooked in the platform economy. But as Angela said, inevitably regulation in some form or the other is going to impact on the platform economy and the ability to be able to offer solutions. The next 2 are probably the most important for financial inclusion. Number one, when we look at the first of which is solution providers. So these are maybe companies, startups, not necessarily even startups. It could be an existing company starting up a whole new business. But these are solution providers who bring some form of solution to the market. And then finally, you have the end customer. And the end customer could be you and I as individuals. It could be corporations. It could be other companies and the like. So those are essentially the 5 role players in the platform economy. Key for financial inclusion is the ability for solution providers who on their own may not be able to get mass market adoption of innovative products or services. So somebody may come up with a really brilliant idea which helps to, it increases transport efficiency use or peer-to-peer lending and the like. But on their own, they won't ever be able to adopt to gain mass market adoption of their product. But the moment they partner with a few big established names and basically put their offering or their solution into somebody else's platform, all of a sudden that very small company now has access to a very wide market. And that in itself is financial inclusion, because you're taking small businesses and you're actually granting them or giving them the opportunity to scale and to build. And then finally, for customers or end users, the benefit of being able to go to one place, one platform, to click on simply one website, one app, usually a digital channel, it offers you not only your traditional banking products or services, but it offers you a number of other products or services. And because of your loyalty to that specific brand or that bank or that telco, you find that you're actually getting better savings, you're getting better opportunities. Sometimes it also reduces the friction of compliance, because if you've already been compliant by your bank or being deemed compliant by your bank for one set of products, you may automatically, be deemed compliant for the next product. So it reduces that barrier to entry. So like this, I think platforms offer significant opportunities for companies in fostering the SDG goals. Now, if I were to take a step back and look at the main or the primary benefits, I think the first is scaling innovation. Because platforms provide digital innovation and they allow mass market opportunities for small players, you'll find that a number of companies who, like I said, traditional or who may have a very wide client base are able to onboard smaller role players and give them the ability to scale. The benefit for consumers then is immense, because you now have real innovative technologies coming to the fore, very helpful technologies, and now being offered to a wide variety or a number of clients. This in itself reduces cost in theory. It should encourage, because of mass market adoption, it encourages standardization of the type of solutions on offer and the like. The next benefit of platforms, it enables cross-border innovation. So you in South Africa may be developing something that's extremely innovative, but it may not necessarily exist in the UK, for example. And because of that cross-border innovation, platforms offer the ability to actually take very innovative solutions and scale them globally and usually cross-border. Inclusion and accessibility, as I mentioned, this is probably one of the biggest benefits of platforms, because it enables access to financial services, to marketplaces. It also offers opportunities for the traditionally underserved populations to get access to products or services. It enables financial inclusion to a number of services, including digital banking, microfinance, remittances, etc. And then other benefits include data and analytics. Because of the way platforms work, there's a lot of data generated through usage and through tracking consumer behavior. Obviously, that comes with legal risks, and today is not meant to be a privacy lecture, so I'm not going to focus on all of those legal risks which emanate on platforms. But if we look at the benefit of data analytics, by leveraging data analytics, platforms can provide very powerful insights into consumer behavior, resource usage patterns, environmental impacts, etc. And that in itself helps to develop further innovation, because if you find that you are conducting some form of analytical study, and through that study, you actually gain insights that certain people are behaving in a certain way, you may be able to offer insights to actually mitigate the impact if that behavior is detrimental to ESG goals. And then finally, I think the key to platforms, it enables collaboration and partnerships. And that in itself has significant benefits for the economy overall. So in conclusion, I think while platform economies may not directly align with the SDGs, they do offer real great opportunities for scaling innovation, for scaling disruptive businesses, driving developments towards sustainability, and fostering cross-border collaboration and innovation. So I think if for companies who are looking to adopt platforms, or for companies or fintechs who may be thinking, how can I benefit from a platform? There's significant opportunities on offer. And if you're smart enough about the way you offer solutions, you may actually be able to align these very easily to your ESG goals. And that makes things like attracting investors, etc., a lot easier. Thank you. Thank you.
Thanks, Ridwan. I like the point you've made around the sharing of ideas, because I think when we're solving these sometimes insoluble problems, that sharing of ideas becomes critical. Priyanka, I was going to ask you about data, this byproduct, as Ridwan has said, of all of this interaction with technology. But I see Angela does have her hand up. Ange, do you want to ask a question of Ridwan or make a comment?
Sorry, Jess, I know I should be doing this, but it's now that I'm on this mission about the 14-year-old and the 4-year-old with the old wine, as you say, at just one point, Ridwan spoke of mobile money and the MNO operators. Now, everyone knows how valuable cell phones are and data recharge. And a lot of the MNOs offer this data recharge. Now, surely data recharge, whereby you are entitled to get data and repay it when you recharge, and you repay it in airtime, surely that can't be something that falls within the purview of the National Credit Act. So just to my point, one's got to be very circumspect in the application of applying existing laws to new technologies. So sorry, and thanks for indulging me on that, Jess. It just came to mind as Ridwan mentioned it, but thank you.
No, thank you. And thank you for underscoring that point again. I mean, I think that is a frustration that we as lawyers feel sometimes when we can see the application of these new technologies and these innovations, and are frustrated at the hurdles to them. So Priyanka, we were talking about data, and not the data that Angela was just talking about now, but rather the data generated by this interaction between consumers and solutions providers through platforms and other technologies. And of course, that is very valuable, as we know, and as Ridwan has raised, is valuable to the solutions providers and the companies that can harness it. So what do fintech companies or those getting into the space really need to think about when looking at their data risk strategy? Because of course, yes, there are lots of opportunities, there are also some risks to consider.
Thanks, Jess, and thanks everyone also for attending today. So I mean, regardless of where a company is in its fintech journey, data has always been there. It's always been a critical asset of a business and that life force that keeps a business going. And as Angela mentioned, fintech's not new. So the risks with how fintechs are managing data aren't new, but those risks come through with how they actually deal with data. And the more digitization a company goes through, of course, the more data the company is using, and then the more risk. And added to this, ESG has become a focus in the financial and corporate landscape, with attention on a company's role in the health and sustainability of our planet and general social equality and cohesion and those things. So a company's ESG strategy, as Ridwan says, looks at a lot of data. And then on top of this, we are indeed globally seeing a move towards tighter regulation of data, particularly in the context of privacy and security. And here in South Africa, our privacy laws were only brought into force about 2 years ago, but privacy and the handling of information has certainly been on the country's agenda for a very, very long time. And broader than South Africa, our global market has shifted to cater for privacy and data-related laws in countries that actually have a far stronger bite when it comes to enforcement. So for example, those in the UK and the EU as well. And companies that are in heavily regulated sectors like banking and insurance aren't new to rules and requirements regarding data, but our privacy laws have just added a new lens through which compliance needs to be viewed as well. And I think it can be perhaps tempting to see privacy law and regulation as a wet blanket to innovation and development. And we've seen this tension between the rise of digitization and the increased reliance on data and what seems to be almost a response from the law and how that data is wielded. But I think it needs to become necessary for companies, especially in the fintech space, to navigate that tension and try to make it a bit more malleable. So what does this mean from a privacy perspective in respect of, all this data that you're sitting with? And I think we need to go back to, why do we have these privacy laws? They're not saying you can't use data, but at their heart, they're just saying that you need to be able to protect data and be transparent with how it's used. So as we mentioned, like ESG involves a lot of potentially risky data as well, looking at consumer behavior, looking at sensitive aspects of the market as well. So it's important to know that although you can use data, you need to be responsible in how you use data and comply with the law. And as an initial step, I think it's important to first pause and reflect on what data you're actually using. It may sound like a very obvious thing to say, but it's only with understanding what data you're using that will actually inform the measures you need to implement to protect and secure that data. And if you look at our privacy law, POPIA, and what it says about information, companies need to implement both technical and organizational measures to secure the integrity and confidentiality of personal data. And what these measures are left at your discretion. You'll need to consider things like what information you're using, why do you need that information, where it's going, are you sharing it with other entities as well, who's touching it, who's accessing that information. And then even if you take all the best precautions to safeguard data, you apply Fort Knox level type of security, a breach is inevitable in this climate. But a breach doesn't mean failure. You could have implemented the best security measures, and the cyber guys out there are always one step ahead. And that's the reality. So you have that against you, as well as the fact that our privacy laws actually apply quite a very low threshold to trigger what is a security breach. When do your obligations to engage the information regulator, to engage customers and any other affected data subjects when there is an issue? And the sad thing is, an unfortunate thing is that a breach could range from something as simple as sending an email to the wrong person to a full-blown ransomware attack. So you need to approach it from two angles. The first is protecting data, implementing measures to secure that information. But then once a breach does take place, having the right measures to respond to it and mitigate it. The trends we're seeing is that it can take companies several months to even realize that they have been breached by a compromise, and then even further period to actually mitigate the damage that has been caused by that security compromise. So it's very important to be proactive and implement quite robust risk frameworks and policies, and making sure you have notification templates ready to go and plug and play when there is a breach. So you don't have to worry about all that stuff. So it allows you to focus on a security compromise when it does occur. And then another key focus I just want to touch on is building and keeping customer trust, which of course is always critical to building a brand, maintaining your reputation in the market. And the more digitization you go through, the more data you're going to be using. So it's very important that your customers understand your data strategy. They know what data you're handling and touching and why. And that's often managed through things like privacy statements, policies, anything that's public facing, just to boost that kind of transparency. Now, there are a number of other security and privacy measures that POPI and all kinds of privacy laws require you to implement, but we don't have the time to go through all of that. But it's just important to remember that privacy laws have at their heart protection and transparency of data, and they require various measures that you need to implement to meet these objectives. So companies should just familiarize themselves with those requirements and plug the gaps if not done so already. Thanks, Jess.
Thanks, Bianca. And I think you've brought to the fore this tension almost that we've been grappling with a little bit in this panel. Angela raised the concern with regulation being a hurdle and being restrictive and not enabling, which Ridvan also touched on in his, what he added to the panel. And what you're showing us is the other side of regulation and how important it is to protect customers and consumers in this rapidly changing space, and how that's also important. And we know that treating customers fairly and ensuring the protection of customers is also very important from an ESG perspective and from an integrity of business dealings perspective, as well as the good governance that you're talking about and ensuring adequate compliance policies and procedures in place. So there is this implied tension that we need to navigate at all times. Maybe to take the discussion a little bit left off field a little bit and talk to Bernard now. So if we're talking about data, and I think one of the most critical questions for you, perhaps as an IP lawyer, and you can unpack this a little bit for us, is who owns the data, and not just who owns the data, but perhaps in all of these innovative spaces, and as we look at fintechs trying to disrupt, coming up with new and unique ideas, who owns that idea and who owns the IP becomes pertinent, and is also another one of the tensions we need to think about in this space. So let me give you your space to share your view with us.
Thanks, Jess, and thank you to all our participants today. Good afternoon. So yeah, data these days is considered as the new oil or liquid gold. And as my panelists have mentioned before, companies are increasingly using data to make more informed decisions and in developing products with that data. So now when we look at data and its interplay with intellectual property, the data is not necessarily owned by the company, but they can be copyrights in the data table structures, the data architecture, the hierarchies or frameworks built to capture and then utilize the data. So just in short, if you transform or capture the data in a unique way, there might be some copyright in how that is done and achieved. So it is, however, also very important to build a framework of contractual protection around the data that is captured. The purpose of this will then be to limit access to that data by third parties, as has been mentioned, to avoid things like breaches and to preserve the confidentiality thereof. And as also mentioned, I think we are increasingly seeing how companies are hacked or information is leaked. So it is very important to have all those frameworks in place just to ensure that the data is protected. Now, when you collect large sets of data over a long period of time, it can result in the identification of some interesting commercially beneficial trends or trade secrets and know-how. And this is for me very interesting. A great example of this that I've come across is that all the major food chains in our country and abroad, they have amassed data over years, and they are looking at the sales, what products are preferred at what time and what day. And what they've actually done with this data is they can predict exactly the number of burgers or pieces of chicken that need to be produced every day to avoid food shortage. And this allows them to meticulously plan their production line every single day of the year. They know what traffic to expect on weekends, public holidays, sporting events, you know it. It's very powerful stuff. And this is currently being implemented and used in South Africa. As they use these data sets in South Africa, they also use it across the world. But now, what happens when you use data to create or train algorithms that are then capable of performing a set of instructions to generate predictive information or on a particular set of data, or they can generate a unique output. Now, just a side note, an algorithm is just a set of instructions, and there are other buzzwords like neural networks, heuristic models, deep learning, forests, and the like, but all of these are just a set of instructions. So when we start looking at these unique outputs and generating predictive information, we start venturing into the realm of software patents, and these are actually protected by software patents. And interestingly, the stance on software patents, it varies quite a bit between the different jurisdictions. When we look at South Africa, Europe, and the US, for example, in the US, they have a strong stance that they encourage the filing of software patents, and they're very much in favor of it. In South Africa, it's a bit unique because the South African Patents Act says that a computer program is not patentable because it is protected by copyright. However, the very next subsection, it says that just because something includes a computer program does not preclude it from being patentable as such, they like to say in legal jargon. But what that basically means is, as you can imagine, every single invention these days has a computer element in some form. So the result of this has that large companies and local companies in South Africa have been filing software patents in South Africa because they deem it as one element of that invention. I think a very nice example in South Africa is the Vitality Reward System developed by Discovery. Now, as you might know, what you need to do with this program is you need to visit the gym, or you need to run a few times a week, and then you amass points, and then you need to reach your weekly goal. The more you exercise, you move up in the levels from bronze, I think it's blue, bronze, silver, gold, and then diamond, which I'm still chasing. And then you are provided with some discounts on your flights and groceries. Now, the problem is, and as you can imagine, is there can be some behavior that is not proper, I want to say. So it has resulted in them developing a new software whereby they are monitoring whether the user is committing some kind of fraud during the exercise, which is quite interesting. So what you need to do is you need to wear a smartwatch when you do this training, and then it measures your biometric data, and it measures things like your heart rate, geolocation data, elevation, your running speed, and things like that. The system or the program then compares that data to benchmark data or historical data that Discovery has amassed over the years. And then it can determine whether you have perhaps given your smartwatch to a more unfit person that is running with your watch. And then they have obviously an elevated heart rate. So then it immediately picks up that you have another person has used it, and then they won't give you the points. The other example your friends might have told you about is they like to put their watches on their dogs to get their 10,000 steps per day. And it will easily pick up something like that as well. So I don't think it is being fully implemented as yet. I've noticed on my app that they're giving some markers, but I think the algorithm is being trained, and they will eventually launch it as the model is being trained and grown and will give more accurate results. But for such patents to be valid, it is required that they solve some technical problem. Now, essentially, this means that the software must go beyond simply processing or organizing data, and it must provide a technical solution to a technical problem, which is in line with what I've discussed above, not simply performing a calculation like a calculator, I would say. Examples would be improving the performance or functionality of a computer system, or by improving the way that data is processed or transmitted. So those are just broad strokes. So I also have a keen interest in data analysis. So I build dashboards tracking for different clients, how they are filing patents across the world and in what technology fields. So we look at patents that are expiring, or perhaps where they have not filed patents in South Africa, meaning they don't extend their protection to South Africa. The consequence is that this technology can be exploited. So just a side note, patents are publicly available, great source of information, sometimes better than scholarly articles. So don't forget to include those in all your searches. But you require some proprietary software to be able to identify these trends. So just for interest's sake, I've noticed a near exponential, not near, it's definitely exponential increase in patents being filed in the sustainability and environmental space for fintech innovations, where they incorporate these aspects as well. So I have my dashboard open next to me, and in 1990, they filed across the world about 400 applications. In 2019, it was 10,000. So that's massive. So some examples of these type of patents, just from me perusing the patents and the records, as Angela has also mentioned, a lot of them include these subfolders such as blockchain, smart contract solutions, and other fintech products. These provide advantages such as data being validated faster transactions locally and cross-border. It's also been mentioned by my panelists. Improved logistics systems for the faster transportation of assets. The list goes on. Further examples that also been mentioned is mobile digital wallets and robo-advising or chatbots. Now on that front, and it was also been mentioned, there's a lot of overlap, we didn't plan this. A lot of banks are migrating to completely web-based or platform-based locations. And these robo-advisors or chatbots are being trained by historical FAQs and data to be able to answer near every single question. And it's rare that you actually need to engage with a person before they can accurately answer your question. If you've got a lot of Discovery clients here, they've got a WhatsApp bot that is amazing. It can answer almost everything. So these bots are continuously learning and improving every year. So it is quite interesting how they are developing these products. So a lot of these fintech products use large data lakes, which is a collection of a lot of data. They can assess a client's risk and identify their spending pattern. And this is then compared to benchmark data to provide them with financial products that match their exact user profile. So that's just the power of data. I mean, in the old days, you had to go knock on doors. These days, you click a button and you know exactly what that client needs or wants. So I think this overlaps as well with what has been discussed. Blockchain and cryptographic products, they also add another layer of security, whereby the share ledger technology makes it very difficult to transfer funds fraudulently. So there are several examples of software patents whereby a model is continuously trained to easily detect when a user performs an action that amounts to a fraudulent act, or basically just veers away from what is considered normal. It is immediately pinged, and then the system freezes that transaction until it is further investigated. So these are all amazing technologies being developed. And I would just encourage you all, there's a great MIT course it's for free on YouTube by the president of the SEC in America, Prof. Gensler, where he discussed blockchain from beginning to end. Sometimes YouTube really is amazing. And I just found it very nice that during his introduction, he said that in Africa, M-Pesa, which originated in Kenya, which is a banking service product whereby people could exchange minutes, he says that it was one of the inspirations for blockchain. So in essence, this innovation in Africa to cater for the unbanked was a great inspiration for the development in blockchain technologies and digital currencies. I just think that was a great thing I came across. So now you might ask, what countries are investing heavily in these technologies? And you would think it's blockchain companies or startups. No, it's actually, from my statistics that I found out, top of the list, it's Visa, MasterCard, Bank of America, JP Morgan, SAP, Microsoft, IBM. So it's all of these large companies are identifying that these technologies can save them on time. It can improve speed, give you more efficient solutions. And this in turn makes it sustainable because it uses less electricity. And all that time you're achieving superior results. So it is just an absolute win-win situation to implement these sustainable technologies. Now, I also keep a keen eye on the African patents. And I just want to confirm that these companies are filing extensively across Africa. And there's also exponential increase in these companies investing into filing patents across South Africa and the rest of Africa. So it is interesting to see that they're identifying Africa as a strongly emerging market, and I believe it's just going to increase over the years. So I spoke very fast now, trying to keep to time. So I want to finally say that I know the rise of artificial intelligence and all these different models and algorithms. People might think that it leaves them nervous, that their job might be at risk. But I firmly believe that data models and algorithms and all these types of innovations, they can be used to not only offer more sustainable solutions, but they also provide us with more professional time to interpret and implement these innovative products. So we should actually be seeing them as another arm to work with and just to achieve results much faster and with more efficiency. And my conclusion, therefore, would be that Africa should embrace data in a sustainable way, of course, and continue to develop and protect all these unique financial or fintech innovations. So, Jess, I see we've just hit 1 o'clock.
Thank you.
So if you don't mind, do you want to conclude?
Yes, thank you very much.
Okay.
Let me jump in there and wrap up quickly for us. Thank you to everyone for joining us, and thank you to the panelists for sharing your insights. And it's been actually very nice to hear from all of you from a very different perspective, each of you talking from your own practice area and your own passion or interest, but all of you actually saying very similar things. And as Bernard noted, a lot of overlap between what's been said between the panelists, which I think is comforting, that we're all thinking the same sorts of things around these emerging technologies. So thank you again, and to everybody for joining us, and please do join us again for the remaining masterclasses, where we hopefully will drive some more discussion around some of the other pertinent topics that we think deserve some deeper thought. Thank you very much. Goodbye.